Hello guys, welcome to Ken's Money Matters. This is FinaTips, a quick stop shop for those who want to understand finance. So today I'll be describing active investing versus passive investing. These are two core principles or ways of investing, and there's always a debate on which one is better. I believe they're all different depending on your investing goals. Active investing and passive investing, both of them have their advantages and disadvantages. So I'll basically explain what they mean and how they do it and what are some of the advantages of each, and then of course you decide based on your goals with regards to your investing process. I will start by describing what active investing is. So simply, active investing is whereby there's a portfolio manager. They do proper analysis of the asset, depending whether it is a stock, a bond, real estate, whatever it is. So they do a deep, proper fundamental analysis of the stock for the short term or for the long term, and decide if they should buy or not, or sell. Basically, they make that decision based on the analysis that they do. So they actively get involved in the management of the portfolio. They buy, they sell, depending on what they believe will happen. So it's actively managed. They can be very expensive because of that. Somebody is always there doing that work, so they can be much more expensive compared to passive investing. They can also lead to a lot of capital gains tax. Basically, every time you sell or buy or do something in the portfolio, there is some tax you pay. So at the end of the day, you end up paying more tax. So they may not be very tax efficient. And again, apart from being expensive and being very highly taxed in terms of capital gains, they are also sometimes very expensive and difficult to run. This is because of the risks involved. So if you actively trying to pick which is the next best stock, which is the next best bond, basically there are more risks involved. So it carries a higher degree of risk. Those are some of the disadvantages. Of course, the advantages could be that you end up getting higher returns than the market return, or you end up getting very good stocks. For example, you invest in Tesla and it runs to 50%. That is a good return for you. So it is, of course, it has its advantages. But again, like we said, each of them have their advantages and disadvantages. Going to passive investing, this is whereby you invest for the long haul. You invest for the long term. You don't go in the market selling and buying all the time. There is less buying and selling within the portfolio. You get into the market, you put your money. The most common one is whereby you follow a particular index. It's called index fund investing. For example, you follow the S&P 500. So you invest your money in a way that it tracks the market, the whole market. So you basically own the whole market. If the market goes down, you go down. If it goes up, you go up. And because over a long time, it has been proven that the market will always give a particular return, which is very positive, around 10%, 9%. You basically go for that return. So again, it's less risky because you just following the whole market. You're not picking stocks, you're not buying or selling stuff, basically just putting your money in a particular index and tracking the market. So it's much more straightforward, it's much more simpler, and it's passive. You don't have to do much within the portfolio apart from simple balancing now and then. So passive investing, again, the advantages being is less costly compared to active investing. It's more tax efficient because there's less buying and selling within the portfolio. And of course, final advantage could be that you get very constant returns and there's less risk. So your returns are very easily determined based on the returns of the whole market. So there's less risk with regards to passive investing. Of course, time and energy is much less consumed in passive investing. So some people prefer passive investing. So you make a decision on whatever you want. Personally, I prefer passive investing. And sometimes I do a bit of active, but largely, I do prefer passive investing because I have other things going on in my life. I don't want to be determining stocks, going into details about particular stocks and particular bonds and stuff. So I just like doing my part, saving the money, putting it in there in the vehicle and expecting certain returns every year. I don't want the risks that come with active investing. There you have it, active investing versus passive investing. So you decide which one you actually want to get involved in. You can do more research and of course come up with what you think would suit you and suit your psychological needs too. Anyways, thank you. Till next time.